Good evening, everyone. Thanks for joining me on the off night. I really appreciate those of you who could make it tonight. I'm sorry for the short notice of canceling and moving this week. And we'll probably have to have this lecture on Wednesday of next week as well. So thanks a lot. I really appreciate your professionalism on letting me change that. All right, so let's share desktop. All right, can everybody see the slide deck I have up here? Awesome, thank you very much. Well, here's the good news. You've come in on an off night. It's a great night to be on the off night because this will probably be the shortest lecture of the year. So, good for you. So let's just jump right into it. The homework, I must say, I'm really impressed with the quality and the thought and some of the thoughts that were introduced in the discussion. Just really good. And somebody brought up about the total market size and included how much of the market they had, and just I think you guys are doing a terrific job, and I think a lot of you understand it. And yeah, sure, it's made for TV, kind of cheesy, but it really does kind of explain how the world really does work in those instances. So thank you very much. And so just kind of some examples of the things that you could have said, but most of you did. Also, there are some things that came up around NPV and IRR. We do have some links in the bibliography, and obviously people have posted those as discussion items as well. So this will be something that will be relevant to our discussion tonight. So I am asking the question, what is capital budgeting? That sounds really official and great and all that, but what in the world is it, right? Well, the real world finance word of the week, I ought to write these down, shouldn't I? I'll tell you what I'll do. I ought to write them down and make a quiz on them for extra work or something. But the finance word of the week this time is CapEx. So what does that mean? That just means capital expenditures. And what does capital expenditures mean? That means spending money on really big stuff that lasts a long time. If you are an accounting major, it is something that is big enough that you would capitalize it on the balance sheet and not expense it on the income statement. So this is CapEx, capital expenditure, so big stuff. So if you're in the manufacturing business, it might be a new manufacturing machine, a new printing press. It could be, if you're in the mining, it could be new mining equipment. In my business, it's, trucks and trailers. And it could be, in many cases, it could be real estate and facilities. Perhaps you are in the Whataburger business, as I've used it a dozen times here. Perhaps you want to build some new Whataburgers, right? So the point is, how do you figure out how to budget for, invest in, make a decision as to whether you should invest that money or should not invest that money? Because this stuff is really, really, really important to the firm's future. So what does that mean? Why is that so important? Well, why would you have CapEx? Well, one is you might need to replace things. You probably know that you've been driving your car for a long time, and sooner or later that thing gets worn out and you just need to replace it. You might only, another thing might be maintenance. You might live in your home for 20 years. You don't want to really replace it, but you might need a new roof. You might need to do something to it, so you want to do some maintenance on your facility. So you would want, there are many reasons why you would have CapEx. And in my business, and we look at CapEx in two buckets. One is replacement, so an asset that has depreciated in its effectiveness financially so much so that it's time to replace it with another asset, or one that is growth CapEx. So in this case, expansion CapEx is that I have displayed here where it says expansion, right? So replacement would be one. Two, you might be able to reduce costs. For us, when we expend CapEx, it usually does reduce our cost for the most part. Maybe the facilities raise our cost, but if we're buying a new truck, typically they're more fuel efficient and have lower maintenance costs related to them. And in the automotive industry, they typically have much more safety gear on them now to keep things from lane departure warnings or adaptive cruise control or things like that that can reduce the cost of accidents or operating the vehicles. You might want to expand. Once again, this is my example of we're in the Whataburger business and we have them in Mount Pleasant and Mount Vernon, but now we want to put them in Paris and Bonham. So expansion would be another one. And then, perhaps you want to have new markets, not just new markets, but maybe new products. And so you have, you're doing Whataburgers, but now you want to put up taco cabanas or something like that, or perhaps you are. You're selling Coke and you want to sell Diet Coke with lime sugar free. I don't know what it is, but you may have new products, new markets, and oftentimes you may have new customers, and this happens to us in our business. We'll have a customer that says, hey, we'll do business with you, but we have some very specialized freight, and we'll need some specialized equipment to be able to handle that, and so we may have to expend money on CapEx to be able to accommodate that specific customer's needs. Another great reason to have CapEx clearly is safety. You may want to invest to improve the safety of your people, much like we do in our business. Everybody driving a big rig, safety is a huge issue, and honestly, the newer the truck, the safer the truck. And so we invest in a very new fleet, a very young fleet of trucks. Honestly, just a little over 2 years old is the average age of our truck. So very young fleet because they're much safer. Maintenance, you may need to, particularly if you have real estate and facilities, you may need to refurbish a roof would be very common type of CapEx. Every 10 years you might have to spend $100,000 to replace a roof on your building. There are lots of reasons you may need to expand your facility, but to maintain your facility, perhaps it's gotten old or aged and you need to come in and refurbish the equipment, the facilities. Also environmental is another big reason for CapEx. Perhaps you have a certain type of boiler or generator or produce a certain type of output that environmentally you need to become cleaner and greener, and you would spend capital to achieve that. And governmental regulations drive a huge amount of CapEx. So particularly in businesses that stuff comes out of a smokestack or an exhaust pipe or sends effluent into rivers, or if you're in the corporate ag business, unfortunately animals do go poop, and so they have to deal with that, and there's a lot of governmental regulations around how to do that safely. So there's lots of reasons why you would have CapEx in a business. But if you're going to have CapEx, well, how do you figure out how much you should spend on it, if it's a good idea or a bad idea? Because, hey, guess what? We're in the finance department. We get to opine. We get to say, hey, that's a good idea or that's a bad idea, right? So how do we do that? Well, first we want to budget the CapEx, and there are different ways to say that, capital budgeting, but I would tell you in a typical budget situation in my company, for example, you would think a budget is really your profit and loss statement projected for the next year, how much you think your revenues are going to be, what do you think your labor costs are going to be, what do you think your facilities and occupancy costs is going to be, and you estimate in the future what you think your company should do. But we also, just so you know, when we budget, we're a big company, but we budget not only the income statement, but we budget the balance sheet, and we budget the cash flows, and we budget very significantly CapEx. And I want to know what the plan for capital expenditures are for a minimum of the next 12 months at all times, and where we're going to spend it, why we're going to spend it, and how to justify it. And so to do that, you want to estimate the cash flows, inflows and outflows, and that could be a pretty extensive project, and we can cover it a little bit later in the course as it relates to the estimation, but I do want you now to understand the concept of this, which is the easiest to estimate is the outflow. What is it going to cost me to buy this? So if I have to buy a new truck, a new printer, a new lawnmower, a new building, a new piece of real estate for my Whataburger, costing is pretty easy. Well, it's not easy, but it's easier than estimating what you think the inflows of cash will be. Well, if you're mowing, 5 yards a day, and if you bought another lawnmower, you could hire somebody and you could add another 5 yards a day, well, you can figure out what my outflow is going to be. One, I've got to buy the lawnmower. Two, I've got to pay the other person to push the lawnmower or ride it. And your inflows are what are you going to charge your customers, right? So you've got to estimate all the inflows and outflows of cash related to this expenditure, this capital expenditure. And so you just want to model around that. Also, it's one thing to say that I will be able to do that, but you don't really know. So if you're building a Whataburger, you could take the results you've had from your 3 Whataburgers you already own and estimate how much you're going to make on your next Whataburger. But frankly, you're probably going to dig in a little deeper. You're going to understand what the traffic patterns are, how many people live within so many radius, how many rooftops, meaning how many housing units or near where this Whataburger is to be built, and you will estimate based upon your historical experiences and using those types of metrics to try and estimate what you think the inflows and outflows would be for the new Whataburger that you would build. And you also need to begin to assess the riskiness of the cash flows. So if I'm selling Dr. Pepper in Texas and I want to sell it in Oklahoma, it's probably going to work, right? But if I'm selling Dr. Pepper in Texas and I want to sell it in Guam, may or may not be quite as certain. So you want to certainly constantly assess what you think the riskiness of the achievement of these cash flows, particularly the inflows, are. But on the outflows, obviously costs can escalate on you. So you need to assess the riskiness of all of those, because it's going to be a component of your evaluation of this. And it will be a part of the calculation formula when you run your NPV or your IRR. The other thing that you want to do is you want to determine the appropriate cost of capital. And what that means is, we talked about the weighted average cost of capital, but to take on this project, what is the capital going to cost you to do it? Are you going to borrow to do it? Are you going to have to raise equity to do it? Are you going to have to do a blend to do it? So you want to understand what the cost of capital really is. And then once you have estimated the cash flows, you figure out how risky it is, you determine what the cost of capital it is, you want to apply the appropriate metric. And typically that would be an NPV or an IRR in a corporate environment. And this is a gross oversimplification, but if the NPV is greater than 0 or the IRR is greater than the weighted average cost of capital, then you would do the deal, right? Because you're making more than it costs you to get it. Now, if the estimated cash flows are $100 and your NPV is $101, I don't know about that, but it's got to exceed it to some level that makes sense for you and your organization and your history and your knowledge set. So one, you want to understand what's all going on in this project and then assess what you think that deal would do. And oftentimes, as I've said before, when you are in a company, there's always somebody who's got a legitimate use for cash. So there's almost always going to be competing applications for cash. So you're rarely going to have the luxury of only evaluating one CapEx project. Most of the time, people are going to want to spend money on your business. So many times you can review them independently. So if it works really well, you just go ahead and do it, because the acceptance of one project does not affect the acceptance of another. However, you may only have so much money, and you can only do so much, which is very common, and frankly that is probably the most common scenario, is there's only so much money. And so you need to understand also it's possible that they could be adversely affected by one or another. So you need to think of that. I'm a part owner of a pizza chain here in Dallas-Fort Worth called Connie Rosso. And we had our first store in Deep Ellum, and we were going to open up our second one. And we were going to open our second one in Lakewood, which is really close to a neighborhood in Dallas. And I was really worried that we would open up the store in Lakewood and it would cannibalize sales from Deep Ellum because they were close enough together. But eventually we decided to do it, and really kind of the moral of the story is I was wrong in my first instinct, because the sales at Deep Ellum, the original store, went up because there was less of a wait time and people were willing to stick around and fill every available slot, more than they would when you said you got an hour wait or something like that. So, but the cash flows can be affected adversely if you accept one or over another. So you need to think that through. So you may only have so much money, or if I'm trying to do a deal in Northeast Texas, does that affect the sales I already have in Central Texas or North Central Texas or something like that? So you really need to think that through. But there's three basic ways to deal with this. One is payback. Second is NPV. Third is IRR. Payback, man, it's beautiful. It's simple. It's easy to understand. You can explain it to your mom. But all it really is how long does it take until your investment is paid back? So if you invest, you know, $100,000, how long does it take until you're paid back your $100,000? Now, you would use different, standards in different situations, but I'm telling you, they won't tell you this in a textbook. They'll tell you you have to go run the NPV calculation, but people in their mind automatically calculate payback. They want to know how long it is till I'm whole, because once I'm whole, then everything above that is gravy, right? So they think about it. So you see that a lot in early investments in restaurants and high-tech deals, because payback is key. And so we'll talk about payback a little bit more in a minute. The next one is NPV, or net present value. We've kind of talked about that ad nauseum, but it is the standard in estimating what's the value of a stream of cash flows of a period of time. And once again, as you know, we need to be talking about the net present value, and include the original investment in the calculation as we went through when we did the calculations. The other metric that people like to use a lot is internal rate of return. It's ironically, the IRR is the discount rate that would make net present value equal to 0. And I see IRRs particularly in oil and gas deals, where people like to use that as kind of a standard metric just to compare one project over another. It's used in many situations, but I see it a lot in oil and gas. So let's talk about payback. It's just really the number of periods it takes to get your money back. So it could be a number of months, it could be a number of years, whatever, but it's just as simple as how long does it take your money back. So it's just queuing up the money, cumulatively keep accounting for the cash flow of the project until such time as the cash flow would turn positive. Now the book shows it this way, which is in the first year I put down $100, so I'm negative. The first year I made $10. The next year I made $60, and somewhere out here I turned positive between years 2 and 3 when payback occurred. They have a simple payback calculation, which is really easy to do. Typically, I just run a forecast of income statements over a period of months, and then you can just do the cumulative cash at the bottom of the income statement, and you can see when cumulative cash turns to 0, and that's your payback period. You can get there multiple ways, but it is a very simple calculation. As you can see, you're just cumulating the cash. If you're negative 100 plus 10 equals negative 90, plus 60 equals negative 30, and at some point out here you turn positive. And this is the way you calculate the actual timing. It's not necessarily so, because cash flows aren't exactly purely even, but it's a really good representation thereof. Now, it's not perfect. The strength is, it really gives you an idea of what's the liquidity of the deal, how much cash is generated in this deal, how fast, and it really helps you understand the risk of the investment very well, because if it takes you 25 years to get payback, that's one thing. If it takes you, 18 months to get payback, that's another thing. You might think about, hey, should I put in a brand new air conditioning unit in my home? Should I put in a solar panel in my home to save money off my electric bill? I'm telling you, the first thing you're going to think in your brain, and the first thing the salesperson is going to say to you is, what's the payback period? That's how that works. So if I put $7,500 in the solar panel in my home to reduce my electric bill, how long until I've paid back and I'm equal? Is that 3 years? That might be worth it to you. If it's 8 years, I don't know, right? So that's the strength of payback. The other thing is, as I said, it is really simple to understand, and you can explain it to anybody. Now, the weakness is it doesn't take into account the time value of money, and it does ignore any cash flows that happen after payback. But the mentality of payback is, I put my money in, I got my money back, I'm whole, I can't be damaged from the point of payback forward, so everything is gravy, right? The next thing is, once again, net present value. And it's the sum of all the present value of all cash inflows and outflows of a project, right? We've talked about this. So the basic idea for NPV is if the present value of the stream of cash flows exceeds the cost, then the value of the business has increased, and therefore you should do that. Therefore, if you are as we said earlier, if you're evaluating independent projects, you would accept it if the NPV is greater than 0 or some measure greater than 0. If they're mutually exclusive, you would accept the project with the highest net present value, because that would add the most value to the business. Now, similarly, there is the internal rate of return. And it is the discount rate. It is a rate that forces the present value of inflows equal to cost and the NPV equals to 0. So once again, it's an iterative calculation, and here's the way to solve for it in Excel. And because it's an iterative calculation, you've got to give it a starting point, so you guess what you think the rate will be. So it's pretty easy if you do it in Excel. If you don't, it's not. But we used to solve them on handheld calculators, and you had to sit there and wait for the thing to iterate through all the calculations to come up with the internal rate of return. So once again, the rationale for the IRR is if the internal rate of return is greater than the cost of the money it takes to do the project, then there you've got return that would increase the company's value. So if the IRR is greater than the cost of capital, you would do the project. If it's less, then that you would reject the project. It seems simple. Obviously, you want to have some delta. It can't be just slightly over, 1% over, but over, you would want to do that. Same as NPV. If you had independent projects, you would accept both, and if they're mutually exclusive, you would accept the IRR with the highest IRR. I don't think we have to go through this. This one is, to me, is kind of important, and this is an important distinction mathematically that you need to understand. When people use these terms, that you understand what's involved in them. The net present value assumes that the cash flows are reinvested at the weighted average cost of capital or at the discount rate or the interest rate that you used in the NPV calculation. That may or may not be true, right? So the discount rate that you used in the NPV calc might be, you may have put a pretty high discount rate in there so that you could accommodate for the risk. But if you have inflows from that, you may only be able to reinvest it at 1% in a savings account. Now, our method is flawed dramatically because the cash flows are assumed to be reinvested at the same rate at which you're earning an IRR. And if you're doing an oil and gas deal, you may hit some wells, you may not hit other wells, and some may have a higher rate of output than others. And so that's a pretty stout assumption to assume that just because I can make a certain rate of return on one deal, when the cash flows come back out, I'm going to be able to reinvest them at that same rate of return. That's a pretty stout assumption. So, the point is cash flows are more realistically going to be reinvested at something closer to the opportunity cost of the capital than the project return rate, and therefore the vast majority of finance professionals prefer the NPV method. And it is the best method to use to choose between mutually exclusive projects as well. However, that doesn't mean IRR is invalid or wrong or shouldn't be used, but it's a good second checkpoint. But most finance professionals, not all, but most finance professionals believe net present value is the best to be used. Now, since the IRR has some issues with it, perhaps there's a hybrid that could, instead of assuming that the cash flows from the project are reinvested at the IRR, which is earning, which is, by the way, why it's an iterative calculation, right? So it's got to take the return and then recalculate the return at the inflows that are coming at the return. So that's why you've got to give it a guess as a starting place to see if it can find it. So back here, so if you could, perhaps you could do an IRR that instead of assuming that the cash flows are reinvested at the same rate at which you're earning, but what if they could do what the NPV can do, and reinvest at the cost of capital or opportunity cost of capital. So there is something out there, and it's called the modified internal rate of return. You do not need to know how to calculate this. I just want you to know that it exists and why it exists. But it does an IRR, but it assumes that the cash flows are reinvested at the cost of capital, or the opportunity cost of capital, or the discount rate, whatever you want to call that you use in your NPV calc, as opposed to the earnings rate of the investment. Now, why would you use modified IRR over IRR? Well, so managers like rates of return comparisons, and MIRR, or modified rate of return, internal rate of return, is better than internal rate of return. And it involves a simple mathematical assumption that's probably not likely to be true. And that, as I stated, is your shortest lecture of the semester. Does anybody have any questions, comments, suggestions for improvement? Okay, great. Well, enjoy the rest of your evening, and remember that next week we will, there's a 75–80% chance that we'll have the lecture on Wednesday night next week as well, as I'll be out at an industry convention, and it's kind of unpredictable as whether I can make the right time at Tuesday night, but I can for sure make the right time on Wednesday night. So we'll go from there. All right. Thanks, everyone.